Most people fear when markets get loud. I make my clearest decisions in those moments. This isn't just about courage. This is the ability to see the difference between noise and real risk. In September 2008, the morning Lehman Brothers collapsed, Wall Street was completely engulfed in chaos. Screams on CNBC, panic on Bloomberg, news about the end of the financial system everywhere. Everyone was doing the same thing, running. I shut off the phone traffic. I locked my office door. I began thinking in silence. Because to see real risk, you first need to silence the noise. During that terrifying morning, while markets dropped 15%, I asked myself these questions. Is this panic real or perception? What is systemic risk? What is temporary fear? Is what everyone's running from what I should be buying? When the answers began to clarify, I reached a historic decision. We would buy Bear Stearns. When I announced this decision at the board meeting, the room filled with ice. "Jamie, this is madness," said our CFO. "Markets are collapsing and you're buying?" "Markets aren't collapsing," I said. "Markets are cleansing." This is where my different risk perception emerged. Most people mistake noise for risk. I know noise as opportunity. During those chaotic days, while conducting Bear Stearns negotiations, there was complete hysteria outside. Media was writing the end of banking. Analysts were drawing apocalypse scenarios. Even some of my employees were considering resignation. I wasn't listening to any of it. Because real risk assessment requires emotion-free analysis, and emotion-free analysis starts with blocking noise. When I examined Bear Stearns' books, what I saw was this. Yes, there was a short-term liquidity problem, but the underlying assets were valuable. The problem was timing, not quality. While doing this analysis, experts on CNBC were screaming Bear Stearns is worthless. I bought it for $2 billion. A year later, that acquisition was worth $20 billion. Noise was wrong. Analysis was right. So how do I distinguish between market noise and real risk? First rule, don't confuse volume with value. What's loud isn't always important. What's quiet isn't always insignificant. Second rule, look at balance sheets, not headlines. Media sells drama. Numbers tell truth. Third rule, the risk everyone talks about is usually not real risk. Real risks come quietly. I applied these rules during the 2011 European debt crisis. During that period, media ran daily stories of Greece collapsing, Italy sinking, euro ending. European stocks had crashed. Everyone was fleeing Europe. I was examining European banks' financial statements. What I saw? Yes, there was short-term strain, but most banks' fundamental structures were solid. The problem was liquidity, not solvency. While doing this analysis, Bloomberg was broadcasting End of Europe programs. I started investing in European banking stocks. Result? By 2016, our European portfolio had grown 300%. Noise was wrong again. How well can you filter market noise? When everyone's panicking, can you stay analytical? Most people can't. That's why most people lose money in noisy markets. A similar situation occurred the night Trump was elected in 2016. When election results were announced, futures markets had dropped 5%. They were writing, "Markets reject Trump." I thought differently. When I analyzed Trump's policies, what I saw was tax cuts, deregulation, infrastructure investments. These were positive for the banking sector. I placed buy orders at midnight. "Madness," said a trader. "Markets are collapsing." "Markets are overreacting," I said. "I'm underreacting." The next day, SPY hit records. My midnight purchases had gained 8% in a single day. The difference between noise and reality was clear again. But the biggest test came in 2020. When the pandemic was declared in March, markets had gone completely mad. SPY had dropped 35% in 30 days. VIX had reached 80. They were writing Great Depression 2.0. I was recalculating my risk matrix. What was systemic risk? The virus was temporary. Economic activity had stopped, but hadn't become permanently stopped. Government and Fed would intervene. While doing this analysis, CNBC had end-of-the-world programs. I was buying stocks. "Are you crazy?" my wife said. "Why are you buying when everyone's selling?" "Because buying when everyone's selling is the most guaranteed way to get rich," I said. 6 months later, my portfolio was at record levels. Pandemic noise had masked real risk. This is the secret of risk assessment in noisy markets. Think contrary to the crowd, but not blindly, analytically. When SVB collapsed last year, a similar situation occurred. Media wrote banking crisis, regional banks collapsing, system in danger, they said. I analyzed SVB's business model. What was the problem? Asset-liability mismatch, duration risk, concentration risk. Then I analyzed JPMorgan's position. Did we have these risks? We didn't. While doing this analysis, markets were selling all banking stocks. I was buying JPMorgan shares. SVB crisis will spread, they said. Sector will collapse. SVB's problem is SVB's problem, I said, not the system's problem. I was proven right. SVB crisis didn't spread, sector didn't collapse. Analysis had beaten noise again. So what mental framework do I use in noisy markets? First step, emotion versus data separation. Filter emotional reactions, focus only on data. Second step, temporary versus permanent analysis. Separate temporary problems from permanent problems. Third step, specific versus systemic assessment. Separate company-specific problems from systemic risk. I apply this framework in every noisy period. When Fed started raising rates in 2022, tech stocks crashed. They wrote, "Tech age is over, value investing is back." I did different analysis. Rate increases were temporary. Technological transformation was permanent. The problem wasn't valuations, it was timing. While doing this analysis, tech sector had dropped 40%. I started making selective tech investments. Result? This year, our tech portfolio showed strong performance. Another example of noise-reality separation, crypto collapse. When FTX failed in 2022, media wrote, "Crypto is dead." Bitcoin dropped from $69,000 to $16,000. Everyone said, "Bubble burst." I analyzed technological fundamentals. Would FTX's collapse kill blockchain technology? No. Were all cryptos worthless? No. The problem was speculation and leverage, not technology. While doing this analysis, I took selective crypto positions. Result? Bitcoin saw 40,000 again. Fundamental technology survived. The biggest mistake in noisy markets is panic selling. The biggest opportunity is panic buying. Which do you choose? Most people choose panic selling because emotional decisions provide comfort. Analytical decisions require courage. I choose courage. This approach has a cost: constant criticism, misunderstanding, being misinterpreted. When I bought Bear Stearns in 2008, they called me crazy. When I bought stocks during pandemic in 2020, they called me insane. When I bought crypto in 2022, they called me speculator. When I was proven right in each case, they called it luck. Not luck, system. Finally, let me say this. Noisy markets offer the greatest opportunities because noise masks real value. To see real value, learn to silence noise. If you can silence noise, you can make historic decisions. Can you silence noise, or are you still listening to media voices? Because those who listen to media voices live media stories. Those who do their own analysis write their own stories. I prefer writing my own story.